This is an income statement. An income statement forms part of the final accounts, which is the second type of accounting that we have learned so far this year. As we have discussed in class, there are two parts to a final accounts, income statement and statements of financial position. We are going to concentrate on the income statement for the purposes of this video. The first thing I'd like you to bring your attention to is the heading. As with all things in accounting, it is very important that the heading is correct. You will find the details of what the heading should be in your question. So for example, the heading in this particular question, it names the account, which is the income statement. It names the company, which is Joy Ltd, Ltd being an abbreviation for a limited company. And the following is this very important phrase called for the year ending. And then it will give the date, which is the end of the trading period. In other words, this particular company, Joy Ltd, began their accounts on the 1st of January 2017 and ended their accounts on the 31st of 12th, 2017. The income statement itself is actually divided into two parts. It goes from the turnover all the way down to gross profit. That is referred to as the trading account. Whereas the remainder then from the less expenditure all the way down to reserves, that is part B, which is referred to as the profit and loss account. For the purposes of this video, we've abbreviated profit and loss to P and L, and we should know at this stage as well that the word account is regularly abbreviated to A-C. Now let's look at the purpose of both the trading account and the profit and loss account. Firstly, we have the trading account, and the purpose of the trading account is very simply to find this thing called gross profit. The purpose of the P&L is to find this thing called net profit, which is down here at the end. The difference between the two is very simply gross profit is equal to net profit once you take away all these things that we will know from doing double entry accounting called expenses. So in other words, gross profit is all the money or the income that the business receives from selling its goods and services. However, as you know from doing gross pay and net pay and first year wages, you don't get to keep all the money that you receive because you have to pay these things called bills, or what we now know as expenses. And that means gross profit less expenditure or less expenses, according to the heading here, will make us end up with net profit, the money we get to take home. So we probably can see now that there are many commonalities between a household and a business in terms of the money that they receive, the money that they need to spend to pay their bills, and then the money that they get to keep. What is different is the terminology. In other words, the words that we use, the key words that we use to describe how this happens. So let's take a quick look at that. Firstly, instead of gross pay, a business has gross profit, and that's the money that they receive, the income the business receives after selling all their goods and services. And just like any household, there's a whole slew of bills, but we would now call them expenses, wouldn't we? Because we know that through the alert system that we learnt about when we were talking about double entry and learning about double entry accounting. And that leaves us with our net profit, and our net profit is the money that we have left over, the take-home pay or the net pay that we talked about, but only if we were talking about a household. So, key distinction here. When we're talking about a business, we're talking about gross profit, we're talking about expenses, and we're talking about net profit. When it is a household, it's gross pay, it's bills or tax, or it's net pay. To finish, we are now going to discuss what the business can do with their net profit, the money that they have left over after paying all their expenses and selling all their goods and services. The first thing that the business could do is give some of their profits to shareholders. Shareholders are outside investors into the business who gave the original owners or the original people who started Joy Ltd, the name of this particular company, the money to start the business. And as a reward, every single year, the shareholders get a percentage of the profits. In this case, it was 5%, and we call these dividends. We don't call them shares of the profits. We have a particular word called dividends. And if you look closely, the word makes sense because you can make up the word divide out of the word dividends. That's an easy way to remember that it's a division or part of the profits. It's calculated on issued share capital. We'll discuss this later in another video when we talk about the statements of financial position. Finally then, once the dividends have been paid out of the net profit, the business is left with what is referred to as reserves. Reserves in this case for Joy Ltd was 10,200. Reserves is what the business will keep, either for a rainy day and put into savings, or it will reinvest it back into the business. This has been a video explaining the layout, the definitions, and the purpose of the first part of the final accounts, which is referred to as the income statement.